Hi, everybody. Welcome. Okay. So, welcome everybody to another episode of our series. Today, we're going to talk about, more specifically, we're going to go down the road of technical analysis and we're going to discuss, present moving average strategies. More specifically, we're going to go over what moving averages are, just a small recap. We're going to see what are, in a sense, the parameters that must be met in order to use correctly the moving average strategies, in a sense, and put them in place. We're going to do a live session after this small, let's just say, recap. And hopefully, if you have any questions, I'll be more than happy to answer them. Please let me know in the chat which instruments would you like to go over today. So it's going to be a little bit more interactive compared to the previous ones. So feel free to let me know what would you like me to go over. For the time being, I think it's time to begin. Okay, so again, welcome to another episode of our webinar series. Today is going to be moving average strategies. This is a quick, a small risk warning and a disclaimer. You can read this at your own time. So do that and move on straight to the point. So let's remember that there are different aspects of technical analysis, different branches of technical analysis, if you would like, at least different techniques and tools that you use to conduct technical analysis. More specifically today, we're gonna go down the road of mechanical analysis. So in the past, we went over charting analysis, which is in a sense decoding more kind of information do individual candles are conveying to us. We discussed in the past that when you adopt or use charting analysis tools and techniques, you're going to probably come across drawing manually on a chart, for resistance levels, identifying gaps and chart patterns, drawing trend lines and channels and all that kind of stuff. Today, we're going to talk about mechanical analysis, which is a different branch of technical analysis. At least that's my way of breaking down the subject. And this kind of topic involves moving averages, oscillators, envelopes and bands, and other technical indicators. Today, as you have already known, or already do know, we're going to talk about moving averages and moving average strategies a step further from that. Okay, so mechanical analysis is indeed being performed by the use of moving averages, oscillators, and envelopes and bands, and many other different stuff. So the aim of the technician is, in a sense, to establish the market sentiment by the help of all these pre-mentioned tools. Okay, so technical analysts or chartists look for technical indicators in historical price asset data to judge entry and exit points. Again, in a sense, we use these kind of tools to provide us with at least the most accurate areas, or to detect the most accurate areas of entering, and exiting a position. So there are several technical indicators that fall broadly into two main categories. We call them overlays and oscillators. Overlays go on top of chart, oscillators go below the chart. Okay, so moving averages are definitely falling under the category of overlays, so they go on top of price action. So technical indicators are also known as technicals, and they're focused on trading data such as price, the most important, volume, and open interest. Okay, so technical indicators are commonly used by a plethora of traders, more specifically pretty much everyone. However, their usage depends upon what kind of trader you identify with. So a long-term trader might not be using heavily technical indicators. However, he might be using a few of them in brief periods of time in order to judge whether the market is moving to his or her desired direction. And in regards to the time frame of the time line or the time horizon of short-term traders, they primarily use technical indicators in much more in high magnitude, if you would like. So short-term traders do use a plethora of technical indicators, and they heavily rely on technical indicators. So at the end of the day, what you need to know is that pretty much everyone can use technical analysis to enhance the probabilities of making or placing a correct trade, or the probabilities, stacking the probabilities in his or her favor to exit the trade with the highest amount of profit. Okay, so entry and exit points are what we are looking for when we apply these kind of technical indicators to our charts. Okay, so again, a visual illustration of what to expect when you use mechanical analysis, or what kind of indicators fall under these two broad categories, which are on chart and off chart. Technical indicators fall under the mechanical analysis kind of branch. So moving averages definitely go on top of price action, much like Bollinger Bands, the topic we have covered in the prior webinar. Ichimoku clouds also go on top. Parabolic SAR, again, same thing, and Fibonacci. So all these go on top of price action, whereas we have mechanical analysis, technical indicators that go off the chart. Primarily, they're all oscillators, and some of them are, for example, the relative strength index, moving average, convergence, and divergence, topics we have covered in the past. The ADX, average directional move and momentum, amongst many others. So today we're going to focus on moving averages. Okay, so what are moving averages? Okay, moving averages is essentially one of the most widely used technical indicators, but primarily because it's super easy to apply to the chart and get a grasp of where the market is headed. Okay, it's a trend following indicator, uses past price action. It's a lagging indicator, and its primary objective is to outline the direction of the trend, if that is not already visible with the naked eye. Okay, that's why we use moving averages. Okay, so if, in a sense, moving averages identifies whether a new trend has begun or has ended or reversed. Okay, so it, in a sense, tracks the progress of the trend. It does not give you information about where the trend is going to move towards to in the future. It compiles information from the past, so it gives you information about what has already happened, and this is what we care about. You want to spot as early as possible the shift in the trend, or at least make sure that the trend is moving to the desired direction, or validating, in a sense, that the trend is moving to the direction that we have already identified, and use that as our guiding principle. Okay, it is not telling you what's going to happen into the future. Please digest this. So, in a sense, moving averages are the average of a certain body of data. This is a crude way of looking at things, but it's a more simplistic and accurate way of understanding moving averages. So, in a sense, what you do is compile information about an X period of time. So, for example, in this case, we're talking about a 10-day moving average of closing prices. You can choose to adjust the closing, and you can do open price, you can do median price, you can do average price, you can do a lot of things, or highs or lows. The basic way of using moving averages are built up, the indicator is built upon closing prices of your desired X period of time. Okay, so 10 might be 20, might be 50, might be 100, might be 200. Obviously, the time period has different implications on how to judge, okay, whether a trend is moving upwards, downwards, or a sideways fashion. Okay, different time frames give you different indications, and that's why we use them in contrast with one another. So we use a short and a long-term moving average in order to see whether the trend is making the progress of shifting, or at least continuing down its path. Okay, so it uses the closing prices of 10 days in this example, and they are all added up, and then they are divided by their number, which is 10. So pure average, okay, statistical average, this is like essentially what it is, a simple moving average. So it's the body of data to be averaged, moves forward with each new day, and hence the term moving. So have 10 periods, you add all those values, all those closing values together, you divide them by 10, and you get a number. And as you progress through time, you add a fresh day to your 10-day moving average and you subtract the now 11th day, you get still a sample period of 10 days. You revise your in a sense, your moving average depending on the progress of the first date or the latest date you have. Okay. So, hence, this is what we call the moving average. So it's not just a static snapshot of the 10 periods last year. It's a rolling forward 10 period that you have in front of you on whatever instrument you have open up in front of your charts. Okay, so by averaging the data, a smoother line is produced, making it much easier to view the underlying trend. And a short-term moving average would have price action much more closely than the long-term one. This is evidently true if you look at, for example, this. So when you have a plethora of moving averages, the ones that are closely tied to the price action are usually, or not usually, but they are almost they are all the time, they are the shorter ones compared to the ones that do not have the price action. For example, make a comparison between the 200-day moving average with the 10-day moving average. You see the 10-day hiding the price action much more closely because it's a shorter time frame, and it compiles information on the short term compared to the 200 moving average, which compiles information for a longer time period. Okay, this is simple stuff. Okay, so the greater the number of time periods used, the greater the smoothing, and the further away of the price action you can see the moving average. That depends ultimately, obviously, on the trajectory or the open and close range of price action. Okay, so if you have a chart or an instrument that trades in this kind of fashion, okay, for let's just say this is a period of 300 days, okay, so this 10 period, if you would like, is going to have a moving average much like this, whereas the 200 period, okay, or 300 period is going to have pretty much the same thing. Okay, so if the instrument is not trending or the range of price action, okay, within this 200-day period is not volatile enough, is not moving substantially, you're pretty much going to have a similar moving average value of the 200 moving average and the 10 or the 20 or the 50. Okay, so it's the gap between the two is going to be much smaller compared to an instrument that is trending in either direction and you have sharp volatile moves. Okay, so there are three types of moving averages. Most people use a simple moving average, even though the exponential is day after day or month after month or year after year is becoming much more popular. Yeah, they have their perks as well. For example, primarily speaking from myself, I like to use exponential moving average rather than small moving average, short moving average, excuse me, than simple moving average, because the exponential moving average has the advantage of weighing, in a sense of placing much more weight on the much more recent time period, recent trading day or trading period compared to the simple one which just averages everything out and assigns equal value to all of them. So, and that's up to your interpretation and your liking. You can use whatever you want. But the point is to understand what moving averages are compiling, what kind of information are they containing. Okay, so moving average is a follower and not a leader. Please make this, please digest this, okay? It follows the market and signals that the trend has begun, but not only after it has happened, okay? So it compiles information about the past. No leading indications are given using moving averages, okay? So this brings us to today's topic. What are the strategies that traders can adopt while using moving averages? I here compiled two, and they're super simple and they're super easy to use and implement and understand. This is not advanced kind of webinar. We're going to stick to the basics. So we're going to use one moving average and the example of two moving averages. And the the live environment, we're going to do this. We use 2 moving average, a little bit more sophisticated than using the one. The 1 moving average is pretty much crude, but it has its own benefits. Okay, 2 moving averages are, in simple words, superior to this, and you will understand more. So the technique by using 1 simple moving average obviously has parameters. Let's discuss them. So when the market closes above the moving averages, this generates, in a sense, a bullish signal. Okay, so using 1 simple moving average, 2 parameters are price action and the moving average. So once you see the price action, once you see the price action closing above the moving average, you can use that as your signal to enter a trade. Whereas when you see the price action falling below the moving average, you can use that as a signal to enter the market, but with a short position. Okay, super simple. Crossing above of price action of the moving average, buy signal, crossing of price action below the moving average, sell signal. Now let's do the 2-day moving averages. So we, in a sense, use a short moving average and a long-term moving average. Okay, so difference in periods. So for example, the small moving average might be, for example, 12 periods, and the long moving average, might be 26 period. So when you see the 12-day or the 12-period moving average crossing above the 26, the long-term moving average, quote long-term, this generates the bullish signal. Whereas when you see the small moving average crossing below the long-term moving average, this generates a bearish signal, and the early indication that the shift or that the trend has shifted, okay, to either direction, depending on whether the short moving average is above or below the long term. Okay, so this is a visual illustration of using moving averages. Take note that we're talking about the long-term horizon of the dollar-yen chart. You can see that's what is this? This is until 2023. We start at 2020. I can't see, they're not clear enough. But still, it's irrelevant. The point here is to spot the crossings between the 2 moving averages. In this kind of case, if I ask you which one is the short and which one is the long, correct answer would have been the short one is the green line, because it matches or it trends much more closely. Okay, it hugs the price action much more nicely compared to the long one. So the green line is the SMA and the blue line is the LNA. And as we said, if you remember, when you see the short-term moving average, the green line in this case, by the way, the colors are irrelevant. You can use whatever colors you want. The point is, when the short-term moving average, in this case, the green line, crosses below the blue line, we generate what we call bearish signal. And in other words, this is the bearish cross or the death cross. This is a sell signal. So you can enter a short position here. Yep, sell. And await, okay, when the next crossover occurs. Okay, so we're talking obviously about a long-term trade here. So sell as soon as you see the confirmation with the breakdown of the price action from prior support level. After you have substantial evidence that the trend has shifted, you enter a sell position in this kind of case because you have a bearish cross, and you close the position down here when you get the next crossover, okay, which is on the contrary what we call a bullish cross, since the green line, the short-term moving average, cross above the blue line, the long-term moving average. You can cover your position with a buy here, okay, and make this amount of distance in regards to money, okay. Whereas on the contrary, when you get bullish cross, okay, and the short-term moving average crossing above the long-term moving average, this is a bullish cross, and you enter the position long here, so you buy here, and you await for the next crossover between maybe somewhere around here, who knows, The point is you will wait for the next crossover in order to close your position and go, in a sense, cover your position, close your buy position, and get out of the market by capitalizing on this upside. Okay, super simple way, super simple strategy. In a sense, we're gonna go over much more meet and greet adjustments you can do while using the moving averages. For example, why use the not only using the crossovers as entry and exit points, but you can calibrate that and get much more and leave less money on the table by looking at different indications. Okay, for the time being, we're going to do the simple stuff, spot crossovers between moving average lines. Okay, so let's go on the live environment. Give me a few moments to bring up a chart. What do we have here? Let me see. Okay, hopefully you can see the chart. We have in front of us, what is this? Apple, okay? AAPL, Apple, NASDAQ. Let's stick with Apple, okay? And you can see this is a blank kind of chart. The only thing it has on top of it is volume. Let's add on our indicators. Let's do moving averages. Let's go with simple. Okay. So a simple moving average was added to the chart. Why is it not showing? You get it. And let's do another one. So let me get my settings up correctly. So let's do moving average, the blue line, even though it does not show for some reason. Where is it? Let me see. What is the reason why? Let's do 26. Let's do EMA. Why is it not showing on the chart? Kind of weird. Let's try different instruments. Maybe there's a problem. I think so. Okay. Give it a few moments. Reload. Okay. This is a former chart of silver. Shall we do silver? Why not? Okay. Let's go back to Apple for a few moments. Okay, so if we store my prior settings, that's good. Let's hide this and use moving averages only. So, what do we have in place here? Looking at Apple, what is it? 1 day chart, daily chart. Let's spot the crossovers. Okay, let's go together. So, let's see, the first one I can spot here is right down here, okay? So we see the, what is it? The black line is the 12 period, so the short-term moving average is the 12 period here. Be adjusted accordingly. Okay, so the short-term moving average is the black line, and we have observed it crossing above the golden line or the yellow line, which is the long-term moving average. In this case is 26. You can do any period. You're going to see the difference while using different parameters. You're going to do that shortly after. So in this kind of case, this generates, in a sense, a buy signal. Excuse me. Buy signal right here. Let's just assume that we're going to place a stop loss order somewhere around here, so we're risking 7%, and we are waiting for the next clear crossover of the price action. Okay, this is where the first crossover appeared, which is called, in a sense, the bullish cross. See, oh, different tool. Sorry, where is that lovely tool? So, in a sense, here we go long. So, we're going to use L, it's for long. Okay, and where do we see the next crossover taking place is down here. Okay, so we're gonna go short in here, or in other words, close our position. So this is, in a sense, what you could have, in a sense, earned while using a simple moving average strategy. So obviously it's not optimal. You can clearly see that we've left money on the table, which is what, close to 7%. Okay, so the next valid area where we saw the point where you saw the crossover was up here. But look at how sharply the price action fell. So the earliest point you could have exited this position would have been somewhere in there, which is how much? Let's see. Let's just assume it was right there. We're talking about what you see here, 35%. Superb. Okay, compared to that, while only risking 7% in order to get 35, which is what the risk reward ratio in this kind of case of 6.37. Obviously, we didn't get this. This is the actual risk reward that we had at this point in time, which is 4.68. Super nice. But yeah, 35% gain compared to the 7% expected loss if it went out the other way. So this, obviously, this moving average strategy in this kind of case works very nicely. So let's assume from here onwards that we are waited for the next crossover, which would have been somewhere in here. Okay, and the earliest we could have entered the picture was somewhere within this red candle down here. So let's do this short position somewhere in here. Okay, and the next target would have been the next crossover, which occurred right here. Okay, so this would have been a losing position. Okay, because we have chased the price action right after the shift has occurred. Okay, so leaving this position open and await, in a sense, for the next crossover would have led to a loss of, let me get my tools. Okay, this is the wrong way of looking at this. Would have been somewhere in here. So maybe we would have been broken even at best. Okay, so no loss here, break even. Okay, compared to the 35% gain that you had in this kind of trade, this is pathetic. Okay, so let's move on to the next crossover section, which is somewhere in here. You move this line out of the, no, this, either this, I want this out of the picture. Okay, so the next bullish cross occurred somewhere in here, and we use the earliest we could have entered the picture was, let's just say, somewhere in there. When did the next crossover occur? So is here. Okay, and at the earliest you could have exited the position was down there. Okay, so let's just say 1.8% compared to this, we would have been 11. So the risk, where the stop loss for my liking would have been somewhere in here, right before the crossover. So you, in a sense, risk 3% in order to get what, 11, decent risk reward ratio. However, the signals given by the moving average strategy would have been tarnishing. You would have left a lot of money on the table, and you can see clearly from here that the best you could have had if you have played this with the signals would have been close to 2%. It's not a loss, but it's not obviously a great gain. So at the end of the day, if you risk 3% to get 2%, that's dismal. Okay, so let's move on to the next. Let's assume that we use this point right here as our as our signal for going short, because we see the short-term moving average crossing below the long-term moving average. Short position here, best entry would have been here, available entry after we saw this clear breakout, this clear crossover. The next position, the next area that I would be looking for to exit is when the next crossover occurred. It did not occur so far, and currently you can see that you are winning, let's just say 5% with this trade. Maximum you could have had so far if you exited the position would have been 9%. So we're currently at 5%, and you see Apple making headway, moving to the upside. So if this kind of trajectory continues and we see something like this, the next crossover might occur somewhere in here, or maybe up here. So the best we can hope of using moving average strategies, we get this out of the way, is maybe 4%, since we went short, okay, while risking at the same time maybe this, so 2%. So this makes kind of sense, okay, to stay longer in this, give the market its chance to evolve. May see, as you can clearly see here from the pre-market value, it's 174.20, so it's below yesterday's close. May see a retracement of Apple to lurker on into this session, or on the same token side of the token, we may see rallying apart from here. Nevertheless, the crossover did not occur, so we await, in a sense, when to exit the position when the next crossover happens. So, can we, in a sense, adjust or alter, okay, this kind of crude way of looking at things and wait for the small moving average to cross above the long-term moving average in order to go long and capitalize on the upside and close the position when a short-term moving average crosses below the long-term moving average? The examples we just followed. Can we optimize this kind of strategy? The answer is clearly yes. And from my point of view, the best thing I would love to see is the usage of RSI. I combine RSI with these two moving average strategies, so an oscillator with an overlay, to give me much more nicer indications. Let's get out of the picture the MACD and leave only the RSI as my signal to exit. Let me enhance and let me bolden up the RSI in order to see exactly where I could exit the market. Okay, and in a sense, I use the two moving average strategies, the entry point, the same way as before. So I wait for the crossover to go long, bullish crossover, that the small moving average crosses above the long-term moving average as my signal to enter the position. And from here onwards, I await for the price action to do something crazy, in a sense, or in a sense, the RSI alongside the crossover with one simple moving average to time my exit. Okay, so in this kind of case, I let my position run. Okay, and you can clearly see no crossover on the horizon. However, using other indications, okay, much like the RSI in this kind of case, I await when the RSI crosses below 50, okay, it's going to match the same kind of signal that the moving average strategies are giving me, the 2-day moving averages. So my first instinct is to watch closely the RSI when it comes crashing down from overbought territory down towards somewhere in the middle of the table of RSI in the value of 60 maybe. So in this kind of case, this would have been an early signal to exit, which would have been somewhere in here. after you see the RSI crossing downwards, which obviously is not the optimal way to trade this. The next signal would have been somewhere up at the tops, where you see the RSI clearly breaking above the 70 once, which is happened somewhere in here, twice, 3 times, 4 times. Here, I'm starting to pay close attention what's going on with the RSI and the momentum. We see a lot of build of pressure. Bulls are eager to push the price action to higher ground. As you can clearly see, the RSI is signaling over extension 1, 2, 3 times, 4 times. So I'm keeping a close eye on the RSI because it goes into overbought kind of territory and stays there and goes once again down and once again up, trades there. That means, yes, the momentum is with the bulls, but this cannot go for longer. So I'm paying close attention to the RSI and I'm awaiting whether it's gonna come back again up the 70 level. This kind of case, it fails and it creates what we call a lower high. Okay, as you can see, this peak here, we have a value of RSI value of 75. Okay, and then you see the RSI forming the lower high, excuse me. And this is what I pay attention to, the divergence between the RSI values and the price action. The price action here, you see, it moves upwards. The RSI is giving me an early indication that the momentum is waning out, and this lower high, when I'm saying lower high, I'm talking about this is one high, this is a lower high, and another one afterwards. Okay, the failure of the RSI to match the price action, which does higher high, higher high, and higher lows at the same time. Okay, we see the divergence, we spot the divergence. When the divergence occurs between RSI and price action, I pay close attention and I'm looking like a hawk the price action to give me a sign that the price action, that it will break to lower ground. Therefore, I'm paying close attention in this area right here for an exit. And you can clearly see that when the RSI failed to record another higher high, much like the price action did, I'm timing my entry, my exit, excuse me, and I exit the position somewhere in there when the first signal that the RSI is not going to go to higher ground, which is somewhere near the area that I have highlighted with this line. Okay, so this is my sign to go away, sell and go away. So best I could have had from this would have been, let's just assume my exit position here was 44%. This is 10%, almost 10% higher than what I could have gotten while using blatantly the simple strategy of moving averages. Okay, so you can clearly see that this kind of optimizes my exit point. I'm using the same parameters to enter the position, whereas the two moving average strategy, whereas I'm using RSI for looking for the RSI for a signal of divergence for me to exit my position and time it and get as much gains as possible and leaving as less money on the table compared to what I could have gotten with the RSI while using solely the two moving average strategies. Can we do the same thing with this kind of trade right here? Okay, remember at best in this kind of case, while using the two moving average strategy, at best what we could have gotten was what? Break even. So let's just say 0.5% gain, irrelevant. Okay, so we went short there and we are waiting for the price action to move to lower ground, and when the next crossover appeared, we would have closed the position. So once again, talking about minimal gains. Okay, not it's not bad because we're not losing money, we're just leaving a lot of money on the table. Can we optimize our strategy, okay, while using RSI? Let's see. So in this kind of case, we're looking for the complete opposite. In this kind of case, we saw the RSI trending in overbought territory. Now we're looking at oversold territory. Does the RSI give me the necessary signal to exit the position before market rebounds? We'll see. So what we see here is that price action broke below, okay, the short-term moving average closed below the long-term moving average, generated the sell signal. Best we could have entered is this. Exit was here. Could we have timed this and exited the position somewhere in here with gains? Let's find out. So RSI, okay, turns negative, okay, after this plunge. So it definitely is with the bears. However, we don't see a lower low. Okay, we see an RSI being stubborn and staying above this kind of range, which is, what is the value here? 37. It does not even come close to this kind of area. And something else to look at, is that the prior price action did this. So fresh low, okay, lower high compared to this, okay, lower low, and lower high, okay. So obviously it's moving downwards, okay. This is the intermediate kind of trend, okay. So the short signal was valid, okay. The market is moving to lower ground. Selling this makes sense. However, we are paying close attention to the strength of the selling pressure. Here we have lower low on the RSI, recording the price action, makes sense. However, after this, we get a lower high. Okay, let me make this much clearer. After this, we have a lower high. So this, the RSI does not validate the price action because we have a lower low, lower high, lower low, lower high, lower low. Does this appear on the RSI as well? No. And this is why we pay attention to the RSI for exits. This is a lower low, lower high, a higher low. Okay. If this was normal, we would have expected to see RSI coming down here, so lower than this kind of level. It did not. It consolidated nicely above the prior low. So here I'm paying close attention to exit the position. Once the RSI perks upwards and moves back towards the 50 level. So the area of my exit would have been somewhere in here at best, okay, after I see two consecutive higher lows, okay. I'm looking to exit my position as soon as possible. So maybe the best I could have gotten here is something like 3%. 3% is obviously better than 0.5% gains or no gains, okay. So this is RSI kind of optimized the trade. Obviously, the best you could have gotten was like 5%. We got 3%, better than using the entry and exit points given by the simple moving average. Good simple moving average strategy. Okay, and in this case, it's exponential. Okay, but still, let's do the same thing here. Entry here, exit here, market. Crossovers appeared here and here. Best we could have gotten was, let's just assume it's what, 2.5%. Did the RSI give me an early indication? Let's see. So what do we see from here onwards? RSI rebounding from the 30, a nice signal, okay? And while it's upwards towards the 70 level, okay? the failure of the RSI to do this gives me an early indication that we may see a reversal, okay, or at least a waning out of the bullish pressure and bears entering the market kind of eagerly. When was my signal to exit? Is when the RSI fails to cross the 70 bound once and then twice. Okay, so curved above it, create a new, okay, new high. Okay, second high, price action is higher. RSI is not making higher highs. It's doing the same thing. So we spotted here another. Let me remove some things off. So higher high, another higher high. This is a higher low. RSI does not confirm it. Okay, higher low, nowhere near a new higher high. Okay, new higher high in the RSI would have been somewhere up there. This is not what we get. We get another divergence with a new higher low. You can clearly spot this here. So I'm using RSI to exit the position somewhere in here at best. I could have earned, let's just say, what, 9.6% instead of nearly what is this, 2.5. Okay, so using two simple average moving strategies, you get 2.5% using the traditional methods. Using two moving average strategies to enter the market and exit the market with looking at RSI, it gives you 9%. Okay, 9.5%. So 9.5% versus 2.5%. There's no debate there. Much better exit signal is provided by the RSI compared to the average crossover. Is the same thing true for here as well? So currently, what do we see here? Currently, we are making, let's just say, 5.6%. It's not clear yet whether the trend has shifted. Can we use the RSI to exit the market much more sooner? Did the RSI provide me an indication that price action is going to start reversing towards the upside and minimize my gains, or is it favorable for me to leave the position open? Let's assess that. So what do we see here? Once again, using price action, we see a lower high. This is the new high. A lower high. Is this confirmed by the RSI? Yes, lower high. Do we have a lower low? Is this confirmed by the RSI? Not really. Okay. Where is this? In here. But it's a lower low. Nevertheless, does the new high, the lower high here is validated by RSI? Yep, maybe it's, where is it? This one. Okay, lower low. Yep, lower low is here. What about this low? Is it validated? Yep, excuse me, lower low is up here. Is it validated by RSI? Yeah, now we start to pay attention. When does the price action rebound from here or not? New high, makes sense, okay? However, price action now, okay, moved to the downside. So we have made a lower low, but RSI has made a higher low, okay? So it was ideal to exit the position here, right where we are. The fact that the RSI consolidated and made a higher low here was an early signal for me to exit the position somewhere in there and make, in a sense, what, 9% compared to the current 5%. Okay, so this would have been optimal for me in this area to exit the position, given the divergence. Once again, let me mark it clearly for you. the divergence of the RSI, okay, rather than leaving the position open. So now we left on the table at least 4%. Maybe today's session, the price action is going to switch to higher ground and we're going to have less potential for gains. Maybe the price action is going to fall lower ground. We will see today's session. But yeah, guys, this is how you use two simple moving average strategy. Pretty much easy, I assume, to understand. If you have any question, please send them through in the chat. We're running out of time. If not, we have to leave it here, and we're going to catch you on to the next webinar for another lesson. Okay, let me see. Do you have questions? No questions whatsoever. Okay, so thanks for watching, guys. Have a lovely weekend. We'll catch you until next week for another webinar. For the time being, this has been it. Take care. Bye-bye.